Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Raymond. Alan, one of my holdings, Cheniere Energy, ticker LNG, has been crushed lately with all the other energy stocks. How can covered call writing help me recuperate some of my losses? Thanks, Raymond. Well, Raymond sent me this email in December 29th, 2015, and I'm producing this video on April 21st, 2016, nearly 4 months later. So let's first have a look at the price chart of LNG, which, as Raymond stated, was part of the energy sector, which took a terrible hit from August of 2015 through parts of January 2016. And here's that price chart, and you could see and kind of visualize the pain that Raymond was experiencing when he wrote email. Now, the question becomes, can covered call writing help recoup some of these losses? Now, in that question, inherent in that question is the fact that Raymond feels that the stock is bound to recover, and certainly we can understand that the energy sector cannot remain depressed forever. So can covered call writing help? Absolutely it can. And so let's have a look at some of the key parts of covered call writing that we may want to implement to assist with a scenario like this. Now, first of all, if we're going to sell covered calls on a stock that we think is going to appreciate in value from the current level, we're going to write out of the money calls. So we're going to write a call higher than the current market value. That's going to accomplish two things. First, it's going to generate premium. And second, it's going to allow the stock to appreciate in value from current market value up to the strike price. Now, of course, as we're doing this, we must avoid earnings reports, as we do in all of our covered call trades. Now, certain stocks, like LNG, have weeklies. So what we could do in this particular case is the month of the earnings report, we could write weeklies up to the week of the stock reporting, and then pick it up again after the report takes place, thereby missing only 4 weeks out of every calendar year. Now, many stocks also distribute dividends, so there's a concern that on the ex-dividend date that the buyer of the option may exercise in order to capture the dividend. Well, that's not an issue with Cheniere Energy. It does not generate a dividend, at least as of April 21st, 2016. So we don't have to worry about ex-dividend dates. But if we did, in my books and DVDs, I teach how to avoid those situations as well. Now, remember, our exit strategy situations remain in place for every trade we're doing, even one that's gapped down and we're looking to recover some of the profits. In this particular case, if we want to hold on to the stock, if the strike is in the money as expiration approaches, we would be rolling the option. And if in fact the stock price declines, despite the fact that we anticipate it going up, then we can either roll down or just throw in the towel and sell the stock. So those are some of the situations that we should be aware of regarding how covered call writing can help. Now, at the time that I'm producing this video, we're going to take a look at an options chain and see how writing an out-of-the-money strike can help us. And at the time, Cheniere Energy was trading at $28.52, so let's look at the options chain strike price of 30. Now that will give the share price an opportunity to move up another $1.48 by expiration, and as you could see on the screenshot, generate a $77 per contract premium. And we know, just quick calculations, that's somewhere between 2 and 3%. But what we do is we take this information and let's feed it into the multiple tab of the Ellman Calculator and see how this plays out. Now, if we feed it into that multiple tab, we have the current market value of $28.52, an option premium of 77 cents, and a strike of 30. And that expires in 1 month on January 29, 2016. Well, the calculator tells us that our return on our option, or RU, is 2.7%. We get that by dividing 77 by 28.52. In addition to that, we have an opportunity for share appreciation from 28.52 up to the 30 strike. If that happens, we will then have generated an additional 5.2% of profit. So our total potential return for the 1 month in this scenario is 7.9%. And as you could see, if we could continue to do that over time, that it will help assist in the recovery of the losses that were incurred from August 2015 until January of 2016. That said, we now have the benefit of hindsight. So let's take a look at the current price chart of LNG and see what happened since that horrendous January when Cheniere had gone down from $80 to $28. Now you could see in the screenshot here that Cheniere went down for another couple of days, and since then has been appreciating in value. Thank goodness for that. And it's currently trading near $35. Now, $35 is well below the high of 80, but still in all a lot better than 28. And remember, in addition to that $7 of share appreciation, Raymond could also be generating the option premium on top of that. So slowly but surely, there can be somewhat of a mitigating situation where the losses will be decreased, and who knows what's going to be in the future, maybe totally down to a break-even situation, or even ultimately generating a profit with this particular stock. Now, one thing I want to mention, we don't automatically stay with a stock that's gapped down. You know, we have to look at a lot of different things. We check the news, what's going on with that particular company. In this situation here, it was obvious the whole oil sector was depressed, and it brought down all the stocks within that sector. So it wasn't the company per se, but rather the entire energy sector was depressed. So certainly you could make a case that it was going to recover and something that we may want to stay with. You could certainly make a case for that. So just to summarize now, when we're using covered call writing in general, we must master all three required skills. That selection of the underlying security, in this case, Raymond already had the stock that he was asking about. Selection of the most appropriate strike price. In this case, to recuperate some of the losses, we would zero in on the out-of-the-money strikes that would give us an opportunity for two income streams in the same month with the same cash, with the same stock, one being from the option side and the other from the stock side. And the other skill is position management. We talked about the possibility of rolling out if the strike is in the money as expiration approaches, or rolling down or selling the stock depending on the price movement. In this particular case, the price movement did head north as Raymond had thought it would. Now, any particular stock that has a huge premium return also comes with it a huge implied volatility or risk. So generally speaking, depending on your personal risk tolerance, you may want to avoid stocks that have a very high option premium. I'm not saying that's the case here, but many of the energy companies do have very volatile underlying securities, which means the premiums look very enticing, but the risk level is also very high. So be careful with that. And finally, as you could see from this question, covered call writing can be tailored and crafted to meet so many different types of situations. Bullish, bearish, volatile, in this case dealing with a company whose price gapped way down over a period of several months. So just didn't happen overnight, but it was going down every single day over a long period of time. Most of us would have considered taking action sooner, but that's water under the bridge. Here we are today. What do? And so I think Raymond, by using covered call writing, based on at least the hindsight that we have of the last 4 months, made a very good decision to keep the stock and to write out of the money covered calls. So Raymond, first off, thank you so much for the question. I think this is something that we have to deal with from time to time. Fortunately, it's not often. We avoid earnings reports, which is the main reason for stock price to gap down. So thank you for that. And of course, thanks to everybody out there for taking the time to watch this video. Hope you enjoyed it. And of course, I hope you ultimately benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.